So good afternoon, class. Today we're going to be presenting Chapter 7, which talks about student and consumer loans. My group is formed by Stella Sarola to my left, Sebastian Coelho to my right, and myself, David Morales. Today we have 5 objectives for you to grasp. I'm going to be covering the first 2, which are understanding the different types of consumer loans and how to calculate the cost of them. So what are the basics of consumer loans? Compared to credit cards, they're far more strict and formal. You get to decide beforehand how much money is going to be borrowed and how you plan to pay it off. With consumer loans, you get to borrow higher quantities of money and get to pay it back at a slower pace. Inside consumer loans, we have multiple elements which we're going to be comparing today. The first one we're going to be comparing is going to be single payment loans versus installment loans. So what are single payment loans? They're also known as balloon loans and are paid back in a single lump sum at maturity, including all interest charges. They are usually less than a year long and are typically used as a bridge or interim loan. Like their name implies, bridge loans are meant to bridge the gap until the borrower can get a more permanent financing, such as a mortgage. Installment loans. They consist of the repayment of the principal and interest at regular intervals. Since we're making frequent payments, our owed principal decreases hand by hand with our interest, since our interest is calculated from our last balance due. We'll cover this in an example later on this presentation. Unsecured loans versus secured loans. Secured loans. They're generally guaranteed by a specific asset. The pros could be that since the risk is lower for the lender because of the collateral, the rates are going to be lower. The cons. The default on payment can result into the repossession of the asset and in some cases, the liquidation of the asset. And the liquidation of the asset might not satisfy the full loan balance. Unsecured loans, on the contrary of secured, have no collateral. Because of this, rates tend to be higher, and because of the riskiness, they are usually only offered to the most credit-worthy borrowers. Now, fixed rate loans versus variable rate loans. Fixed rate loans have a pre-negotiated single interest rate for the duration of the loan and are usually more expensive since the lender holds the risk, while variable loans fluctuate over the life on the loan depending on the market interest rate. Variable loans can change at any time interval and have contractual cap, such as periodic cap, which puts a limit on the interest rate increase from one adjusted period to the next, and a lifetime cap, which puts a limit on the interest rate increase over the life of the loan. Some of these variable loans have the capability of converting into fixed loans. The loans are called convertible loans. There are also other types of convertible loans we can see in practice. An example could be on startups, where convertible loans are used as a short-term debt that may convert into equity in the company. So what's the main difference between short-term loans and long-term loans? Short-term loans are to be repaid in a reduced time frame compared to long-term loans. This equals to lesser risk to the lender and lesser interest to the borrower, but with higher interval payments. On the contrary, long-term loans are to be repaid in a bigger time frame, which implies more risk to the lender, which equals more interest to the borrower. But in this case, we have lower interval payments. In this example of a fixed rate unsecured long-term installment loan of $10,000 at 9%, we can see how each payment is broken down into interest and principal. Since each month payments are being made into the principal, we can see how in the following periods the interest reduces since it's calculated from the last balance. For example, on period 1, we pay $900 in interest, which is 9% of $10,000. Then on period 2, our interest payment was reduced to $780, which is 9% of the pending period 1 balance, $8,670. The loan contract. A contract to purchase an asset will have a security agreement defining who retains control and rights of the both parties in case of a default. These 4 types of clauses these are 4 types of clauses you can find in a contract. The first one, insurance agreement clause, which requires credit life insurance to pay off the loan in the event of a death. Acceleration clause, which is standard in most loans, implies that if the borrower misses payment, loan becomes due immediately. Deficiency payment clause, which is standard on secured loans. The borrower is responsible for the difference in collection costs after liquidation. Recourse clause, which defines the actions lenders can take to claim money, for example, a wage garnishment. We also have special types of loans. For example, an automobile loan, which is short-term, secured, and often used as a marketing tool. We can also find the home equity loan, which uses the built-up equity in a home as a collateral. With these types of loans, borrowers can typically borrow up to 50% to 85% of the equity. So how do we get the equity? For example, you own a home that has a market value of $200,000 and have $80,000 left on a mortgage. Your equity would be the difference between these two. So you subtract $80,000 from $200,000 and you get $120,000. Your borrowing would range from this number multiplied times 50% and the same number multiplied by 85%, which equals a borrowing range from $60,000 up to $102,000. What are the advantages of home equity loans? The interest is tax deductible when used to buy, build, or improve a home. You can use you can use your main home or your second home. The total of the primary and second mortgage cannot exceed the fair market value of the home. If you're in a 25% tax bracket, for every $1 of interest, you save 25 cents in taxes. Here, we have an after-tax cost example. 9% interest rate on a loan at a marginal tax rate of 25%. So what do? We multiply that 9% times 1 minus 25%, and that equals 6.75%. Using the previous loan example, we get $3,375 versus our new number, which is $2,490. The total interest of our after-tax interest saving would be $884, which equals to a 26% decrease. So these are the advantages, but what are the disadvantages? We are using our asset as a collateral, which means we're putting our home at risk. For our second objective, I'm going to be explaining the cost of early payment of consumer loans. So what is the APR? APR stands for annual percentage rate, which is a simple percentage cost of the sum of all financial costs on annual basis, including the non-interest financial fees. What is the Truth in Lending Act? In 1968, the federal government required disclosure of all financial charges and terms on the loans. On the next slide, I'll be giving you an example. Here, we can clearly see all financial charges in this $20,000 loan. In the first row, we can see that our APR is 8.5%. Then to our right, our finance charge, which is the dollar amount the loan will cost you over the 4 years, followed by the amount financed, as we mentioned before, $20,000. For our total payments, which is the sum of the amount financed plus the interest, which equals to $23,662. And finally, the total sale price of the loan, which includes a $5,000 down payment, for a total of the whole operation to be $28,662. On the second row, we can see the number of payments, which are 48 months, followed by the amount of each payment, which is $492.97. And at the end, we can see the date of when the payments are due, which is the 15th of every month. On the third and final row, we can see the clauses of the loan, which we previously talked about on Objective 1. Well, thank you guys for your attention. Now I'm going to leave you with Stella, who will be going over on how to pick an appropriate source of a loan.
Thank you, David. As step one, we're going to pick an appropriate source for your loan. There are 7 types of lenders we can choose from: commercial banks, savings and loans, credit unions, sales financing companies, small loan companies, and brokerage firms. Each of these lenders offers several loans. For instance, commercial banks offer home mortgage, home improvement, education, personal and auto, and mobile home. Each of these options have their advantages and limitations as described in detail on the slide. Loan sources. I have listed some loan sources from inexpensive to the most expensive. Inexpensive sources include family loan, home equity loans, and insurance companies. The least expensive is family loan. You do not usually pay the market rate on a family loan, and the downside is that your family suffers if you can't repay it. The more expensive sources are credit unions, savings and loans, and commercial banks. Although these 3 sources offer loans that are quite similar in nature, credit unions generally offer the most favorable terms. And the most expensive sources are financings from retail stores, finance company, and small loan company. The primary key to get the most favorable interest rate on the loan is strong credit rating. There are 4 ways to obtain the loan relatively risk-free. The first is a use of a variable rate loan. With a variable rate loan, you rather than your bank will suffer if interest rates rise. If you can't afford the payments if interest rates rise, stay away from variable rate loans. Keep the length or the term of the loan as short as possible. The lower the probability that you will experience a financial disaster before you pay off your loan, and the less risk you have of defaulting. Provide collateral for the loan. Secured loans are less risky because the lender has an asset designated as collateral in the event of default by the borrower. Put a large down payment towards anything you're financing. The larger your down payment, the less you have to borrow, and the larger your ownership stake in the asset you're financing. Having a large ownership stake in something is seen as increasing the borrower's desire to pay off the loan. In any debt decision, control and planning are key words. When deciding whether to borrow or pay cash, you have to ask yourself questions like, can you avoid borrowing? Does it fit in your personal financing program? Do the benefits outweigh the costs? Do not borrow to spend if you can avoid it. Decide whether you really need the new item and whether it fits into your personal financial planning program. If using cash to purchase something, we need to think if it affects your goal of having sufficient liquidity to carry you through financial emergency. Controlling your use of debt. Controlling your use of debt consists of 2 measures: debt limit ratio and the debt resolution rule. Debt limit rate is a measure of percentage of your take-home pay or income taken up by non-mortgage debt payments. The formula for the DLR is the total monthly non-mortgage debt payments divided by the total monthly take-home pay. The DLR below 15% is optimal. At that debt level, you still have a borrowing reserve for emergencies and the unexpected. Many lenders use what is called the 2836 rule in evaluating mortgage applicants. If total projected mortgage monthly payment falls below 28% of gross monthly income and monthly debt payment, then the mortgage payment and consumer credit payments fall below 36%. The debt resolution rule is used by financial planners to help control debt obligations by forcing you to repay all of your outstanding debt obligations every 4 years. The consumer credit should be short-term. The logic behind this rule is that consumer credit should be short-term in nature. If it lasts over 4 years, it's not short-term. Here are some clues that you might be in financial trouble. If you answer yes to any of these questions, you might be in financial trouble. What to do to avoid financial troubles. Once you have gotten into trouble through the overuse of credit, getting out becomes difficult and a painful task. You need to make sure it fits into your financial goals and budget. Make sure to recognize how potentially painful and costly it will be if financial discipline is absent. Keep in mind cost of borrowing and how it limits your future financial flexibility. Put in place a budget that brings in more money than goes out. Have better self-control in the use of credit. Talk to your creditor, banks, to restructure your loans, and seek help from a credit counselor. What to do if you can't pay your bills. You need to avoid expensive loans as much as possible. You use savings to pay off debt only in extreme situations. Use a debt consolidation loan and declare bankruptcy as the last resort. Bankruptcy is the inability to pay off your debts. Leading causes are major illness. This generally comes with major costs and possible job loss. Easy availability of credit leads to living beyond your means. Divorce, it's expensive, what with lawyers, child support, and splitting up assets. Job loss, bills continue even with no income. Savings can be wiped out. Chapter 7 and Chapter 13 are two of the most commonly used types of bankruptcy. Chapter 13 bankruptcy is otherwise called as the wage earners plan. Must have a regular income, secured debt of less than $1,149,525, and unsecured debt of less than $383,175 as of March 2014. A plan will be designed to pay off majority of your debts. You will still maintain titles to and possessions of your assets. Relief of pressure from all the debt collectors. Chapter 7 bankruptcy is also called straight bankruptcy. It's a more severe type of bankruptcy. For individuals who don't have any possibility to repay debts, is given the opportunity to eliminate them and begin again. You must pass the means test to qualify. The means test determines if your disposable income is lower than the qualified monthly expenses. If you made more than median income in your state, have more than 100 a month of disposable income, or have enough disposable income to pay off at least 25% of your debt in 5 years, you may have to do Chapter 13 instead. You must complete a credit counseling course within 6 months of filing bankruptcy, and a course in personal financial management before any debts are discharged. Most of your debts will be wiped out, except child support, alimony, student loans, and taxes. The court will confiscate most of your assets to sell to pay off all creditors. Now Sebastian is going to walk us through the student loans and paying for college.
Thank you, Stella. So I'll be talking about something we can all relate to, which is student loans and paying for college. The key to staying protected is to understand what you're getting yourself into. So if you're taking out student loans to pay for school, you need to understand your loan, and more specifically, what kind of loan you're taking out, what kind of payment plans are available to you, and if there's any way to reduce the amount you owe with debt forgiveness. Now, I'll be diving into each one of these segments throughout my presentation. The first step you want to take is learning to manage. And what I mean by that is you need to understand the consequences of your choice of school and what you want to study. You need to understand what the costs are of attending your school, such as tuition, housing, food, and transportation. You need to learn how to borrow less and smarter. You need to be able to manage your money well while on campus, and eventually repay your loans without having to sacrifice your future financial goals. After you learn to manage, you need to figure out what kind of school you want to attend and what major you want to focus on. Here are some facts to consider before making that decision. The cost of an average public 4-year university is about $22,000 a year. The cost of an average private 4-year university is about $43,000 a year. Obviously, in state tuition can be a lot cheaper than out of state tuition, depending on the state. And also, you want to think about how your future income can influence the amount of loans you want to take out, and that can be estimated by what major you choose to study in school. On average, the highest earning majors earn 314% more than the lowest earning majors. So, after considering what kind of school you wanted to attend and what you want to study, you probably shifted your focus on the actual cost of the schools that you wanted to apply to. Fortunately, the U.S. Department of Education has created a financial aid shopping sheet, and the Consumer Financial Protection Bureau provides direct links to costs at, at different schools, including tuition fees, average financial aid, retention rates, graduation rates, etc. Once you've done your research and applied to the schools that you wanted to go to, you must fill out a FAFSA report, and depending on the school, a CSA profile. The free application for student aid gets sent to every university you apply to determine how much aid you will receive. You will then receive a student aid report summarizing all information submitted, which then gives you one final chance to make corrections and list any special circumstances such as expected family contribution. And if you apply to any private institutions, you must also submit a CSA profile. Now, once you're accepted into the schools that you applied to, you received a detailed financial aid letter containing all the information you need to know about paying for school. Once you receive this letter, it's important to go over it thoroughly. You need to know the difference between grants and loans, the cost of attending after aid is received, miscellaneous costs such as dorms, food plan, cost of living in that town, travel expenses, and books. Now, don't worry if the tuition rises because so will the amount of aid you will receive. Okay, now we're at the point where you've accepted your admissions and financial aid, paid your security deposit, and need to pay for those expenses that were not covered from financial aid. Now, when you're comparing your situation to the average student in the United States, here's some things you want to remember. The average student debt for public universities is about $29,000 and $35,000 for private universities. About 65% of students take out loans, which brings the national debt outstanding to 1.2 trillion and counting. So next, I'll explain the specific ways you can pay for college. I'll start with the savings plans. The first plan is the 529, which is a tax advantage savings plan designed to encourage savings for future college costs, and it comes in two forms. The first is a prepaid, which allows college savers to purchase units or credits at participating colleges or universities for future tuition, which can include room and board expenses. The second is a regular college savings plan, which generally permits a college saver to establish an account for the purpose of paying for future college expenses like tuitions, books, and room and board. In both these savings plans, earning growth tax is deferred. Withdrawals are tax free when used for qualified educational purposes, and there is no income limitations. The next type of saving plan is a Coverdell Education Savings Account. This allows you to make annual non-deductible contributions of up to $2,000 per year per person into a designated investment trust account. There are contributor income limitations, and it will grow free of federal income tax. Withdrawals will also be tax-free, and the difference between the previous two plans I mentioned is that this plan can also be used for elementary and secondary schools as well. Contributions stop when the student is 18 and must be used by 30. Any money left over will be taxed and charged as a penalty. Here's a slide comparing the three saving plans I just mentioned side by side for when you're studying for Dr. Taistu's exam. So if a student is not fortunate enough to have these saving plans by the time they get to college, there's other ways to pay for school, which brings me to federal student loans. These loans are funded by the federal government, and the Department of Education is your lender. There's four types of federal loans. The first one is the Federal Perkins Loan Program. It's a school-based loan program for undergrad and grad students who have exceptional financial need. The second type of loan is a direct subsidized loan for undergrad students who have exceptional financial need. The government pays the interest on this loan while is still in school, and you'll have a 6 month grace period following graduation before students begin to pay back the loan. The third type is a direct unsubsidized loan, typically for undergrad, grad, and professional students. It's not necessary to establish financial need, and the student can choose not to pay the interest while in school or during the 6 month grace period. However, interest accumulates and is added to the principal of the student loan. The final type of loan you can take out is a direct plus loan. This loan is made only to grad or professional students. However, if an undergrad student wants to apply, then they must fill a direct parent plus loan. A credit check is required, and interest begins accruing immediately. Payments are also deferred for 6 months. You then have the option to direct consolidation. This allows students to combine all their eligible federal student loans into one loan. Now, when you're taking out these loans, there are details you want to mark down. Interest rates are fixed over the life of the loan. Every year on July 1st, the interest rate on new loans changes. So now you might be wondering how the rate is measured. So the federal loan rate is equal to a 10-year treasury note plus add-ons. So students who take out loans every year might not realize that the rates could have changed. So it's important to look into this every summer. However, there is a cap as to how high interest rates can rise. If you don't want to deal with the federal government or the Department of Education, one can always take out a private student loan. But bear in mind, they will chew away your life with those interest rates. This kind of loan is meant to provide you with funds only after you've exhausted all your federal financial aid or if you did not qualify. These loans typically are offered by commercial banks and credit unions. Interest rates on these loans are variable, so it can go up over time. These private loans can also be very expensive and don't usually provide options to reduce or postpone payments. Like I said before, you should probably stay away from this unless it's a last resort. Now, when you receive your diploma and you're walking down the aisle to shake President Frank's hand, just remember deep down that it's time to become an adult and repay your loans. There are four types of repayment plans with several choices that affect the length of the time you pay, monthly payment amount, interest, and possible forgiveness. First one's a standard payment, a 10-year term, pay the lowest amount of interest. The second one's the extended repayment. It's a 10 to 30-year term with an additional number of payments and additional interest paid. The third is an income-based repayment plan, which is based on a percentage of discretionary income, not the amount owed. It yields low monthly payments, but additional interests are paid, and is typically a 25-year term before loan forgiveness. The fourth one's a graduated repayment plan. It starts low, and monthly payments increase every 2 years. It yields low monthly payments, but additional interest is paid, usually 25 to 30-year term before loan forgiveness. Now, if you come across trouble in your life, there's an option to defer your payments. Here's some reasons in how you become eligible. One, you're still in school, you're unemployed, or you meet hardship standards. So, and you need to remember that you can only postpone payments on a loan for up to 3 years. Interest does not accrue if the loan is subsidized, but it does if it's unsubsidized. Now, I cannot emphasize on the importance of managing your money responsibly. Now that we're all in grad school and already figure out how to pay for our college education, remember these things when you're saving up for your kids. Set up a bank account that benefits college students. Set up savings accounts. Or if you're like Henry Song and loves credit cards as much as he does, set up different kinds of credit cards accounts that offer rewards for travel benefits, just in case they're a little far. Now, here I created a little action plan for all of us to follow. Learn the details of your student loans. Watch your grace period. Keep connected by making sure you update all your information because the government will find you. Now, know your repayment options and pick the one that fits you. If you have any problems, deal with them. Shenanigans happen. What can you do? Go after your most expensive loan first with the highest interest rate. Figure out if you need to consolidate or not, and don't forget to seek loan forgiveness. It's more common than you think. Any questions?